Have you ever been in a situation like this? Your accountant just sent back your tax return. You just paid the IRS a ton of money, and then they slapped you with a bunch of these estimated tax payment vouchers. What the heck is going on? This is something I see all the time, especially for highly compensated employees and business owners. The first thing you have to do is understand what these things are telling you. You see, the IRS has no idea about your financial situation. They only know their rules. So what are the rules? The IRS says that in order to avoid underpayment penalties, you need to pay at least 90% of your expected tax liability or 110% of your prior year's tax liability if you make at least $150,000. So what does that mean? If you just got your tax return, pull it out. Scroll down to the page that says Form 1040 on the top left. Now keep scrolling one more page until you find line 24. This should say total tax. This is the total amount of tax you paid the federal government last year. Now this number is generally satisfied through W-2 withholdings and estimated payments. Now, let me stop you right here. Remember, that number you're looking at is last year's tax liability. Those estimated payment vouchers, those are for this year. So how did they calculate them? Remember, the IRS has no idea what's going on with you. They just know their rules. The IRS says that if you made at least $150,000 last year, you need to pay either 110% of that number on line 24 or 90% of however much you're going to owe in tax this year. The only problem is the IRS has no idea how much money you're going to owe this year. They don't know if last year had some one-off event, if you had a crazy bonus or a stock vest, or sold a house or sold some real estate, had an inheritance. There could have been any number of things that were going on. All they know is that these are the rules. So when your accountant gives you back your tax return, most of the time, those estimated payment vouchers are just a guess. For many high-income earners, their income can be wildly different from year to year. So what's the value in even looking at these things? The IRS has no idea how much money you're going to owe this year, and a lot of times your accountant doesn't either. So they guess. Have a look at those payment vouchers. Add them up. Does that number equal 90% or 110% of last year? Are you understanding how they might have just guessed? Is this year going to look way different? Are you going to have meaningfully less or meaningfully more income? Do you really think you need to actually follow those payment vouchers? What the heck are they trying to prevent anyway? The IRS is really just trying to make sure they get paid. That's what's in their best interest. Sometimes, even if you do follow those vouchers to a T, if you make a lot more money this year, you could still be left with a huge tax liability. Not a great surprise. This is why understanding your tax situation or hiring somebody else who does can be a huge benefit. If you can get to the place where you are making proactive tax planning decisions, it can save you dramatically. If you can quantify the sources of your tax liability, you can avoid these big surprises. And sometimes you can even make changes. Maybe you need to increase your retirement contributions. Maybe if you're a business owner, you can change your structure. If you own assets, you might be able to take advantage of tax loss harvesting. All of these things can be great strategies for the right person and may be able to help you reduce your tax liability. But it all starts with understanding what's going on in your tax return and why you're seeing these estimated payment vouchers. If you found this useful or interesting, give us a like and a subscribe. We'll be sending out more content here real soon.